All right, welcome back to the Annuity Researchers Podcast. I'm Zachary Van Ness, Senior Annuity Advisor at Annuity Association.
Hey everybody, thanks for watching. I'm Matt Sluizer. I'm also a senior annuity advisor here at Annuity Association. And in this series, the Annuity Researchers, we're delivering independent, unbiased reviews of today's top annuities in the marketplace.
That's right. So if you haven't checked us out already, we do have some prior recordings with other product reviews, and we do that in an unbiased way. So today, we're taking that unbiased look at the Nationwide New Heights Select. This is a fixed index annuity designed to offer retirees guaranteed income, principal preservation, and the opportunity for growth linked to marketplace performance. If you're not yet familiar with how fixed index annuities work, we've included a link in the description to a separate video where we explain the mechanics more in detail. In this episode, we'll walk through how the New Heights Select operates, break down its key features and rider options, and we'll also use our software to model real-life scenarios, including actual index performances. And this will show how it measures up in today's marketplace.
But before we get started, just a quick disclosure. This episode's for informational purposes only and does not constitute legal, tax, or financial advice. The product features, rider options, and rates that we discuss could vary by state and also are able to be changed at the insurance carrier's discretion prior to being locked in with an application. The brochures that we reference today are not intellectual property of Annuity Association. And please ensure that you consult with a licensed financial professional if you'd like to evaluate whether this annuity may be a suitable investment for your situation, goals, and objectives.
That's right. So today we'll take a look at this product. There are a couple of unique riders that come with the Nationwide New Heights Select. We'll take a look at its intended purpose for lifetime income and also for the purpose of growth and legacy. So to jump us off, when we take a look at this, there's a few things to note here in this fixed index annuity, again, designed for the opportunity of growth and to protect retirement savings from any negative markets. By doing that, we've got that growth opportunity where the contract may increase in value based on the positive performance of the elected indices. You also have 100% principal protection. Your principal and any credited earnings are 100% protected from any negative index performance. Lastly, lifetime income and legacy. So you can elect to add one of two optional income riders or one of two optional enhanced death benefit riders, which we'll cover in more detail. As I mentioned, we've got the opportunity to enhance that growth. So in looking at this, there's a few unique ways that Nationwide does this. Number one would be tracking the values daily. So it is a unique feature with New Heights Select, and that is that the potential earnings are tracked daily as the daily accumulation value. So you'll see this acronym DAV used quite a bit. And this allows you to see how your strategy options are doing on any given day. So you can log into your Nationwide account, track them, and see how they're performing. Now, along with that comes the option and the opportunity to lock in that positive performance. So your earnings are automatically locked in at the end of each strategy term and cannot be lost due to any potential future negative index performances. If at any point your strategy term, you're satisfied with that return, you can actually lock in that opportunity prior to the ending of that strategy, and it will credit on that end date. And you can do that once per term. By doing that, you capture the earnings on withdrawals as well. So another unique feature of the New Heights Select is that you will receive earnings to date on withdrawals from retirement expenses or if you need to take required minimum distribution. So what does that mean? Let's say hypothetically, you're set up in a strategy, a point-to-point strategy of a 1-year period. You begin that policy date and your ending date is your 1-year anniversary date for that specified period. With that, You capture the earnings if you choose to take that withdrawal, let's say 6 months into it. So you're not missing out of any potential index return during that time period. You're able to capitalize on that and still make that withdrawal. Matt, did you want to add anything on that?
Yeah, that's a huge point, because as we get into the index options available with this annuity, we'll see, depending on the length of the contract that's selected, there's some 2 and even 3-year terms that are available. And so if you have a 3-year point-to-point term, especially if you're taking lifetime income off of this contract, with many of the annuities out there, if you're taking withdrawals throughout that term, whatever your balance is at the end is what they'll calculate your interest on. And so with this annuity, for some of those longer terms, there's a bit higher upside in terms of higher participation rates. And a disadvantage of that would be if you got to the end of that and you've drawn off the balance, and then you're just receiving interest on what the balance is at the end. But in this case, any withdrawals that you take, if that strategy is positive, even if it's in between and they haven't credited interest yet, you'll actually earn interest, any of that unearned interest, based on the amount you have withdrawn. So that's really, I think, a very unique feature of this particular contract, and it's an important one, just to make sure that you're not missing out on any interest opportunity due to that lifetime income withdrawal.
Yeah, so that withdrawal feature, a huge value add. Also, personally, I really like that lock option that somebody would have in this. So going out of order here, but looking back at that lock-in positive performance. Granted, you've got that crediting strategy that will automatically credit if there's a positive performance at the end of that term. So as an example, it's a 1-year term, it credits at the end of it. But you yourself, you have the option to lock in at a different time. So being able to watch this crediting happen on a daily basis allows you the option to lock it in at any given point during that 1-year period. So hypothetically, you're into that 1-year period, you're 8 months in, and you say, hey, the market's up, I want to capitalize on this return from this index, I don't want to ride it out for the rest of the year. You can choose to lock it in at that time. So a couple unique features that we see here with this. Speaking to that, here's an illustration of it. So the retirement savings that you allocate to the New Heights Select and any credited earnings are protected from market downturn, offering a sense of confidence through the changing market. New Heights Select strategy options do not limit the amount of index performances used to calculate the earnings. So this graph below does show how values are tracked daily and locked in at the end of each strategy term, or once per term through an optional lock-in.
Right. So in this illustration, this shows the account value and how the interest is locked in based on those index crediting strategies. And so you can see that it's showing multiple terms here. So it has 5 different index terms. And these are point-to-point strategies. So it's going to measure what was the price of that index at the beginning of the term, and then what is the price at the end of the term. And based on that, they will calculate the interest. Well, once that interest is credited to your account, it's now locked in and part of that protected principal balance. And so we can see a good example of that in the first term. We can see that the index has increased in value. And so there's interest that's credited at the end of that. Well, in the second term, we can see that that strategy has gone through the full second term and the index is down. Well, you haven't lost that new higher value. So that interest that you've received, that is now locked into the account. So you can see in that second term that it stays flat at that point. There would just be 0 interest credited. There's no risk of loss if the index is down during an index term. Now, if we skip ahead to the term 5, it references that index lock. So in the middle of any index term, whether it's a 1-year or a 2-year period or even 3-year, if you were happy with where the index is, it's up for that term, and you're happy with those gains and you want to lock it in, you don't want to risk that maybe the index starts to go the other direction in the second half, you actually can exercise that index lock. And so even if the index starts to decline after that point, you've now locked in that interest. You can only exercise that lock one time during a strategy term, and it'll be credited at the end of that term. And then you'd have the opportunity, if you wanted to, either stay with that existing allocation, or you'd have the opportunity to reallocate at that point.
Right. So let's say, for example, we lock in an index. Let's say we're in a 3-year term. We lock in that index 8 months in. Well, you still have another, 26 months or 28 months remaining for that index credit to occur in your account balance. All right, awesome. Now we jump over to the Nationwide High Point 365 Select Lifetime Income Rider with a bonus. That's a mouthful. So we're going to call it the High Point 365. So with this rider, you have one of two optional living benefit riders available for an additional charge. That additional charge is that rider charge. So should you wish to create a source of guaranteed income, this is really what we're going to focus on. The rider features a predictable source of retirement income through the minimum income benefit value, which is guaranteed to grow every day so long as you follow the term of the rider contract. So with the High Point 365 Select with a bonus, this is providing you a 30% credit to your income calculation on day one. Now, what's important to note is that this does require a 1-year wait to start that income, so keep that in mind. But you have a 30% bonus day one. So instead of your income being calculated on, let's use 100,000 for example, instead of the income being calculated on 100,000, day one, it's calculated on 130,000. With this product, it also has a 9.5% compound annual growth for up to 12 years. So your minimum income benefit value, that calculation of your income, will continue to grow daily at 9.5% compound annual rate until the earlier of 12 years or until you begin taking that lifetime income. So if you chose to start income after 5 years, the income amount will stop growing once you choose to take that income. Or if you want to exercise the option to ride out the full 12 years, you could do that too. The income guarantee, you may begin the lifetime income after that first contract year, like I mentioned, and the date of the younger covered life reaches the age of 50, so whichever is later. Lifetime income is guaranteed to continue for the rest of your life, so it does not have an ending point. So if we're looking at individual or joint, keep that in mind. All right, let's see. So that guaranteed future income growth for up to 12 years, we can see it in the illustration here. If you're looking for guaranteed growth potential for your future income and a source of lifetime income you can't outlive in retirement, the High Point 365 Select with the bonus may be the potential solution. Once your lifetime income withdrawals begin, they're guaranteed for life. So on this graph, we're seeing exactly that. Day one at issue, we see our starting point in the green. The initial 30% bonus launches us up a little bit here, and our minimum income benefit value increases by 30% right away. Then we're seeing, as we move in the contract years 1 to 12, we're seeing that 9.5% compound interest increasing every year. Then once we reach year 12, the minimum income benefit value is guaranteed to more than triple at that point. So that lifetime income can also be guaranteed for you yourself, and don't forget yourself and your spouse through that joint option. So you can make this a joint policy. All right.
Yeah, and one important point to note is that election is made at the time of application. I know there's
Yeah.
many annuities out there that might be flexible at the time that the income is turned on. You could select whether it's single or joint. With this particular annuity, that election is made when you apply for the contract.
Yeah. Great point.
So there's also the High Point 365 Select Lifetime Income Rider. This is an option that does not include the bonus, and it does not include that 9.5% guaranteed growth on the income benefit. So this option would be maybe for someone that they plan to start income at least 5 years into the future. This rider does have a 5-year waiting period before it can be started. And perhaps this person was looking to be more reliant on the index performance to fuel what that eventual lifetime income will be, as opposed to that guaranteed roll up. And in exchange for that, this rider is a little bit of a reduced rider fee. So the way that this works, there is a minimal level of guaranteed growth. There's a 1% guaranteed growth per year for up to 10 years of delay, but it's really more performance driven in that the lifetime income will be based off of the highest daily accumulation value. So over time, as that daily accumulation value increases, at any point, if there's any given day where there's a spike in that daily value, that'll now become the lifetime income benefit base. And if we ran into a scenario where the markets did not do well for an extended period of time, there is that minimal 1% growth. But this option would really be reliant on growing that highest daily value. And then once the lifetime income is started, that's how that income would be calculated.
Right. Awesome. Next, we'll take a look at the income increases, which happen each year that you wait to start that income. So your lifetime income will be calculated based on the lifetime payout percentage and the year in which you begin taking that lifetime income withdrawal. So the High Point Select features some of the highest payout percentages in the industry, according to Nationwide. And the graph below shows how each year you wait to begin taking that lifetime income withdrawal, your payment percentage is guaranteed to increase so long as you follow the terms of the contract and rider. So with this, what it's essentially saying, by looking at this graph, we can see the age beginning point at 63 in the example they're showing. And we can see exactly on the left-hand side, the guaranteed lifetime payout percentage. So it's showing us that if we start taking income at age 63, the guaranteed lifetime income payout percentage is 6.42. What this is telling us and what they're touting is that each year of increase, we're seeing an increase in this case of 4.52%. They're saying that this is the highest amongst each year of deferral, how much it increases over time. So you're guaranteed a payout percentage increase every year you wait to begin taking that lifetime income withdrawal. And in this example, if somebody were to wait till age 68, the starting lifetime income at age 68 guarantees 8.49% payout every year of life. And what we'll do, like we had talked about, we'll stack that up against the marketplace. And, granted, I think what they're suggesting here is, by using this, it's the highest payout percentage in the industry, but there's a couple other factors that determine is that the highest income option on the market. All right. I'll let you run with this one, Matt.
So maybe someone's looking at this contract more for growth and legacy as opposed to lifetime income. And beyond the 2 lifetime income riders that we discussed, there's also 2 different enhanced death benefit riders. Now, keep in mind that only 1 rider can be selected with this contract. So it's not that you could add lifetime income and the enhanced death benefit. It would be one or the other. And so with the enhanced death benefit rider, what it does is that the death benefit would be the highest daily accumulation value, or this minimum enhanced death benefit value, which the minimum enhanced death benefit value is the initial purchase payment, and that grows at a 4% rate for each year. And that will be up to age 80 or up to a max of 200% of the initial premium. So whichever is higher of the two. So this would be for someone that says, hey, I'm looking to safely grow my money. I want to leave this money as a legacy to family, maybe an organization that you're passionate about, but I'm uncertain about the markets. I know that it protects my downside. I know I don't have risk of loss, but I don't know if the markets are going to be as favorable over this span of time. So I want some sort of a minimum guarantee. And so that's what this offers, is that it's this guaranteed 4% growth on that death benefit. But if the markets do well, if the index strategies do well, and that highest daily accumulation value is higher than the guaranteed level, then that would be the death benefit. And so there's two different options with this. There's one without a bonus and one with a bonus. So the one without a bonus, as of today, the rider fee for that is about 55 basis points a year. And then also there's the option for a bonus if you want to get a fast start, get that death benefit growing. It's a little bit higher fee depending on the length of the contract that's selected. It could be 80 to 95 basis points a year. And depending on the length, it could be a 3 to 5% premium bonus that's added on. So those would be the two different options for that enhanced death benefit rider.
Awesome. And just to wrap up the brochure itself, Nationwide, across the board, an A-plus rated company. They're a Fortune 100 company with nearly a century of innovation and leadership. So solid company backing, solid rating. We've worked with them in the past. Very easy to work with, but great company overall, an option to consider. So what we'll do now, we'll allow Matt to jump in. I'll let him share his screen so we can take a look at some real life scenarios that may play out for some of our clients. And I'll let him take over.
So if you've seen our videos before, you know that we have this software that we use to compare where these annuities stack up in the marketplace. And so this is our income calculator, and you can see this okay, right, Zach?
Yeah.
Great. So what I'm searching here, I'm here in sunny Florida, so we'll use Florida as the state. Now, keep in mind that we're looking at these rates as of July 31st, 2025. Rates are subject to change at the carrier's discretion, and also there could be different state variations. So definitely reach out to a licensed financial professional if you'd like to view the rates for your area and determine if this is a suitable investment for your situation. And so in this example, we'll take a look at a married couple, age 55. So we have 55 up here, and then we also have joint lifetime income with the spouse. And we're assuming a $100,000 investment, and we're assuming no income reduction. So we're taking a look at the marketplace based on highest level lifetime income. Once that income starts, it'll remain level as long as one of the two are still alive. And so this is showing the deferral bar where we can put when that lifetime income would begin. So if we start at 0 years, that would be with lifetime income beginning immediately, or we can push this forward to show what the income would be if we delayed it out 5 years plus. With this particular annuity, it's most competitive, especially with that bonus lifetime income rider where there's the 9.5% compound roll up. As that's delayed out further into the future, the lifetime income will become very competitive. And typically where we see this fit in, there's different scenarios, but we could see a couple like this. Maybe they're still working, maybe they have some time before they're going to retire, And we're going to look at closer to the 8 years plus of deferral to see where this stacks up. And so we can move this deferral bar to 8 years of deferral. And see where this nationwide lands in the marketplace. So as far as the highest guaranteed income, we can see that ClearSpring is showing up on top at 12,494. We have Delaware Life, two different variations of the same annuity with them. We have the Corebridge Power Select Plus Income, and then here's Nationwide. So this is the Nationwide New Heights Select. So pretty competitive. This is sorting the entire independent annuity marketplace, and we can see that it's up here in the top 5 for highest guaranteed income. And that would be at the 8-year deferral range. And then if we check a couple other scenarios, so we can look, okay, maybe they have even longer before they plan to retire. And we're looking at 10 years of deferral. So that ClearSpring, Delaware Life, those are still towards the top there. We can see North American, Midland, and then here we have the Nationwide. So at the 10-year mark, it's still in the top 10. It's still up there pretty high. It's not the highest in terms of guaranteed income, although that's just one of the factors. Oftentimes there's other things that are important to take a look at. But you can see how that shifts just depending on when that income is planned to start. And that's where it's important that there's not a one size fits all. We have to really look at what is your individual plan to see what would be ideal for that particular scenario. Now, if let's go out just a little bit further, and let's say 12 years. So that's kind of right at the end of that guaranteed roll up where you're getting that 9.5% compound growth on the income benefit. And so we see it's very competitive at that 12-year mark, and it's in the number 2 spot. So just a couple areas to review on this. This is the rider with the bonus. So we can see that is where you have that higher guaranteed lifetime income. It's not as dependent on the index performance. As Zach had mentioned, these are all the factors of that lifetime income rider. There's the 30% income-based bonus, just meaning they're going to calculate the income off an amount 30% higher than the initial premium. Now, that's not a bonus that you could cash out the contract in a lump sum and get that as cash. It's just simply that they're using that bonus to increase the figure they're using to calculate that lifetime income. And that lifetime income benefit will further increase a guaranteed 9.5% compound rate for each year of delay up to 12. In exchange for that very competitive guaranteed lifetime income, there is a rider fee, which is 1.1% per year. And that is calculated on the benefit base. So that figure that received the 30% bonus and the 9.5% guaranteed growth as it's delayed, that is how the fee will be calculated off of that income benefit base. And once the income starts, there is still some opportunity for upside. So if that highest daily accumulation value, if the indexes do very well, and that daily accumulation value ever grows higher than that guaranteed lifetime income figure that you're getting paid off of currently, they will actually increase your income base to match that highest daily value. And so the lifetime income has the opportunity where it could increase. And of course, that fee would grow along with that. I do believe that it's not very likely that it will. We can see that they're already growing the lifetime income benefit base by 9.5%, and you received a 30% bonus. So the index performance would need to outpace these figures, which to do that consistently over a long period of time, I typically say it's not likely the income will increase, but it's a nice addition where it has the opportunity, and the guaranteed lifetime income is extremely competitive in its own right. Beyond that, if we look here, there's multiple terms that are available. So there's an 8-year surrender period, a 9-year, a 10, and a 12. Depending on the state and depending on your age, the 12 may or may not be available. And so the lifetime income figure is the same with each of these. The big difference is that with the surrender period, that's the point where your ability to cancel would be restricted. So after this surrender period, whether it's 8 or all the way up to 12 years, if you no longer needed the income, you just wanted to get your money out, you'd have the ability to cancel and pull your accumulation value out with no penalties. The other piece to this is that the index rates could be different depending on the contract term that's selected. So in this window, this is showing the highest back-tested performing index strategy available with this annuity. Now there's multiple index options, which we'll talk about in a moment here in more detail, but this is just showing the one that has the highest back-tested performance. So these figures are showing us what the average back-tested performance is over the last 10-year period. And so we can see that it's the same index for each of these terms, but the back-tested performance numbers are a bit different, right? So we can see that as far as the lowest is the 8-year, and then the 10, and then the 9, and the 12. So the big difference between these contract terms is in these index strategies, and the 8 and the 10-year have some 2-year index strategies that are available, where they will measure where the price of the index is at the beginning of each 2-year period and where is it at the end of the 2-year period. And if it's positive, they'll credit interest based off that. Well, in exchange for going the full 2 years before you receive that interest credit, they're offering higher upside potential or participation in that positive growth. And so based on that, on the 8-year, the participation rates are a bit lower than the 10. So that's why the same 2-year strategy, the 10-year, shows a bit higher back-tested performance. Now with the 9 and the 12-year contracts, those offer 3-year strategies. So they're going to look at the price of the index at the beginning of the 3 years and at the end. And if it's positive during that time frame, they'll calculate the interest. And so in exchange for going out that additional year, they offer even higher participation in that index upside. My opinion is normally 3 years would be a bit long in the tooth before receiving the interest credit. Now, Nationwide does have some features in this contract to mitigate that fact that it's such a long time before receiving the interest. One is that if you take withdrawals during that time frame, as long as it's a lifetime income withdrawal or an RMD or something within the allowed confines of the contract, they will actually credit you any unearned interest for that balance. And so that would prevent a situation where you're drawing income for 3 years and just receiving credit on what's left at the end. You do receive that unearned interest based on the withdrawals throughout. And the other piece is also, if you go 2 years and the indexes have been doing very well, and then in the 3rd year things start to backslide and the index starts to go down, that could be a risk of having that long of a term. So the other piece to this is that they do allow for that index lock, where maybe you're 2 years in, you're happy with the gains, you don't want to lose the ground that you've made. You have the ability where you can lock in that index based on where it's at the point on that business day that you actually lock it in.
Right. Yeah, and ultimately that income guarantee is the same income amount no matter which of these 3 products selected. That's not changing from the 8, 9, 10, and 12 year. But what we're looking at is really the driver between the selection of an 8, 9, 10, or 12 year is the index performance and the potential of that performance. And when we look at the 8 and 10, you have 1 and 2-year index options you can choose from. With the 9 and 12, you have 1 and 3-year index options you can choose from. So when it comes to the income, it's not going to change between those. It's more so going to be based on those index allocations and the term itself.
Right. And I wanted to show a quick example of the other rider option without the bonus and the guaranteed roll-up. So if I just pull out the nationwide, so we see at the top here at this 12 years of deferral is the New Heights Select. And if I go down, there's another product from Nationwide, which is the Peak 10, another one that's has a pretty competitive lifetime income. But here is that other New Heights Select rider without the bonus. And so we can see that it is the highest of 1%, or in our software, it says BAV for balanced accumulation value, or Nationwide calls it the daily accumulation value. But essentially with this one, whatever that highest daily value is, that is what they would calculate the lifetime income on. And if the indexes didn't perform well, they offer a minimal 1% roll up on that balance. So this guaranteed lifetime income amount is just factoring in the guaranteed values, that 1%. But of course, this could become quite a bit higher just depending on how that daily value grows. But in exchange for that, it's a lower rider fee. So instead of the 1.1, it's 0.95% a year. And that's calculated on the benefit base. Now, this one, instead of the 1-year wait, it does have a 5-year waiting period.
Yeah, so if flexibility is a consideration, this might be considered less flexible in terms of when you start the income, but may allow for a higher potential in return. But in the comparison, it looks like you're starting at, what is that, about half the income amount?
Yes, it looks like it. Yep, right at about half.
So question just becomes if you're open to that and based on those index performances, or if you prefer the guarantee and no questions asked.
Yeah, great point there. Well, let's take a look at the index options that are available. And so the one that would offer the highest back-tested returns on the index strategies would be the 12, but it really depends, just really what are your goals? Do you prefer a shorter term? Are you looking for the most growth potential? That's where talking with a financial professional and really clarifying what you're trying to do with this investment could help you to narrow down which term is right for you, if this is suitable for you. But when we look at the 12, so this is a list of all of the index options that are available. And so we can see that, as Zach had mentioned, that there's multiple 1-year index options that are available. And what we're looking at here, these are all 1-year point-to-point index options. So they're going to measure what was the price of that index at the beginning of the year and what was the price at the end. And if it's positive, based on this participation rate, they would calculate and credit interest to your accumulation value. And so over here on the right-hand side, we can see these are the back-tested average returns over the last 10-year period. And we also can see that out of each of these index options that are available, there's a option with a spread, and then there's option without a spread. So what the spread is essentially at the end, when they're calculating the interest, they're going to take that spread off of that calculation or off of that performance. In exchange for that, they're giving higher participation. So it's a way to get some higher upside on that index strategy. And it's not a fee. It wouldn't be deducted from the accumulation value. It's just that in this situation, if this Loomis sales discovery is positive during the year, they're going to take 105% of that upside, and then they're going to subtract out this 0.95% from that and credit the difference. And so you would have the ability where you could choose either a no spread or with a spread for a bit higher upside potential. So as far as these different index options that are available, we have this Loomis Sales Discovery, which this one is a combination where it has, based on forecasting, they'll select equities that are either growth or value based, as well as having a fixed component. There is the NASDAQ 100 volatility controlled 10% PR, which is price return, so meaning not including any dividends from the NASDAQ 100. This index will invest in the NASDAQ 100, and each day they'll seek to keep a certain level of volatility. So if the NASDAQ is too choppy or it's either up or down too far from what its running average is, it'll shift some of that position into cash to attempt to protect the value of that index. So this one is invested in the NASDAQ 100, but if it gets too volatile, it'll shift some of that back into cash. And then we have the SG Macro Compass. So this one uses a forecasting as far as what is the state of the economy to determine a strategy, and then it invests in global equities, bonds, and commodities. And then we have the New York Stock Exchange Zebra Edge 2. This one will sort the S&P 500, so 500 largest companies, and it takes out the 300 that are either the most overpriced or the most irrational. So the ones that the price is really moving around on them. And so what's left is those 200 more stable or fair valued companies. So it'll invest in those, but it also seeks to keep volatility low. So it'll also balance that out with a cash and a fixed component. We have the SG Macro Compass. So this particular one invests in global equities, bonds, and commodities. And then we have the Goldman Sachs New Horizon. This is also a global index that has global equities, bonds, and commodities from the US, Europe, and Japan, as well as corporate credit and real estate. And we have the just straight S&P 500, well-known index. So there's two different options, either without or with a spread. And lastly, we have the JP Morgan Mosaic. So that's also a global index that has equities, bonds, and commodities from the US, Europe, and Japan. And so these are the one-year strategies that are available. And there's also the 3-year, so same index options available with the 3-year term, but just something to note. So for example, on this 1-year S&P 500, with the spread option, there's 50% participation. So 50% of the upside of the S&P 500 minus the 1.95% would determine the interest. Now, if we look at that same index with the 3-year, there is a 95% participation rate on the S&P 500 minus that spread. Now that's an annual spread, so at the end it would be 95% of the S&P 500 upside minus just shy of 6%, and that's how they would determine that interest credit. So we can see that by going out to this 3-year term, there's quite a bit increase in the participation rate in exchange for that.
And just as a reminder, on these index options, this isn't a calendar year. So the crediting, it's going to be based on your issue date. So if we happen to issue policy today, July 31st, your anniversary date is when this 1-year or 3-year crediting will occur.
Yeah, great point there. So one of the things that we talk about is that we're looking at these back-tested returns, and of course I see some of these figures 16%. So you look at this and you say, well, why wouldn't I go 100% in this index? And what we've learned is that these indexes are coming out all the time. There's new indexes that are created, And when that happens, based on the components that are within the index and how it operates, the financial institution that creates that index, they will actually perform a back test where they will determine what they believe it would have done had it been around for a 10-year period. And so that's one point of reference, but we also like to take a look and see real time, how are these indexes performing since they've been live? How long have they been out? What's the recent performance? And so that's the next thing that we'll take a look at, as far as what is the raw index performance for these available index options. And so I'm going to stop sharing this screen and pull that up. All right. Can you see that, Zach?
Yeah, gotcha.
Perfect. So this is a list of all of those index options that we just went through that are available in that New Heights Select. And these are the raw performance numbers. Now, keep in mind, many of those index options had participation rates that are over 100%. Some of them had participation rates that are less. These are just the raw performance figures, not including any participation rates applied to it. Also, keep in mind that within a fixed index annuity, any negative performance you would not be exposed to. There's no risk of loss. So as far as these figures, we just have to keep in mind that there's no downside exposure, and the rates we're looking at would have a multiplier applied to them based on the participation rate. So if we look through this, we can see the different columns are the year-to-date performance, the 1 year, the 3-year average, 5, 10, 2023, 2024, and since inception. And so, of course, year to date, we can see the S&P 500 has done pretty well at 8.18%. All of the other index options available with this annuity are down. Now, that doesn't mean that these are bad index options. One thing that we've noted is that many of these index options include an equity component, but also include a fixed component in commodities. And in the rising interest rate environment that we've been in, with inflation coming down, it's really hurt the bond market and it's hurt the commodity market. And also the market has been choppier than typical. And a lot of these index options are risk controlled, where if the market is too volatile, they'll shift more into that fixed and commodity allocation. So these type of index options have underperformed over the last couple of years. But beyond that, we also want to look at, since inception and in recent history, how have they performed? Because one of the fallacies is looking at what is the best performing asset class from the last year or two, because it may not be the best performer moving forward. And that's where having a balanced allocation, where we don't have all our eggs in one basket, would be helpful to be able to earn interest in different scenarios. But we can see that the S&P 500 has done very well, and some of those participation rates are very attractive with this nationwide New Heights Select. The SG Macro Compass, so this one has been out since 2020, so it's been out almost 5 years, and we can see that it's down year to date. It did perform very well last year, so it was up 7.26%. We can see in 2023 that it was positive. I know in 2022 almost everything was down, so some of that since inception performance could be a drawdown from when it took a hit in 2022. But of course, in an indexed annuity, we don't have any risk of loss for those down years. So this one looks to be pretty solid. The JP Morgan Mosaic is another one. So that one has been down on average for the last 5 years. And we can see that in 2023, when you factor in the multiplier, it had some decent performance. But this one, really, since it came out in 2016, it hasn't done a whole lot. And then we have the NASDAQ 100 volatility control. So this one is down this year. It had a solid 2024, so it's been out for 2 years now. And this one, though, it invests in the NASDAQ. If the NASDAQ gets too volatile, it shifts into cash. So there's certainly nothing exotic about that index, and the NASDAQ's done very well. This one, it doesn't have a ton of history, but it looks like it's performed positively since it came out. And then we have the Zebra Edge. So we can see this one is down for the 3-year period. It had some positive performance a little bit in 2024. Just a little bit of performance since it went live in 2021. We have the Goldman Sachs New Horizon. So this one is down for the year, and in 2024 it was positive in 2023. So one of the things with this particular index is that it has the commodities and the real estate, which the increased interest rates hurt that aspect of the allocation. And then we see this Loomis Sales Discovery. So this one has been out just a little over a year. It looks like it is down for this year. As far as the last year performance, a good portion of that is back tested. So even though this is where this one has the highest back tested performance, but when we look at the live, it really doesn't have the track record yet to show if it can perform at that level. As far as the live results so far, it doesn't indicate that. Could be just indicative of the environment we're in, but this would be kind of a wait and see as far as, is this going to show evidence that it can perform positively. But beyond that, there are several strategies here that are solid, including of course, the S&P 500, the SG Macro Compass, the NASDAQ 100 volatility control. And that's part of what we're going to look for is, does the annuity within it, does it have a solid 3, preferably more index options, just so that we have some options down the road to be able to adjust the allocations depending on what's going on in the markets.
Yeah, that's great. Yeah, and really looking at this, there's what, 5 of 7 index options that have been created in the last 5 years. So not, again, to Matt's point, not that there's anything wrong with these. It's just a matter that some of these index options are newer to the market. We have seen some positive performance, and we have seen some with a negative performance. So if there's anything bad with that, just a consideration when evaluating.
Yeah, and if you're taking a look at an annuity, the main takeaway here is, don't go just based off the back-tested returns. You want to compare the live performance as well, and how long has it been since the index has been live. So these are all things that, as we're working with our clients and reviewing the marketplace, that we like to compare both the live performance and the back-tested performance.
That's right. Cool. I think that wraps us.
Yeah. I think so.
Yeah. This does conclude our breakdown then of Nationwide New Heights Select Fixed Index Annuity paired with that income rider, so the High Point 365 Lifetime Income Rider. Now, if you are looking for a better way to explore annuities, one built around transparency, education, and helping you make a confident, informed choice, we'd be happy to assist you. Whether you'd like to speak with one of our annuity specialists or connect directly with Matt or myself, you'll find a scheduling link in the show description. Now, if you're not quite ready, you can also request a personalized annuity report tailored to your specific goals. Whether you're focused on protection, guaranteed income, or a balance of both, just follow the link in the description to get started, and you'll get that free annuity report.
Yeah, thank you again for tuning in. If you found this helpful, please like and subscribe. And if there's a specific annuity product that you'd like us to review, please leave a comment, let us know. And until next time, we're the Annuity Researchers. Thanks again.
See ya.